Welcome to a very special TMS Insights. Today we've got an update on superannuation and some very substantial changes that are pending for 1 July that we need everybody to take notice of because there's some real opportunities. Matt Salmon and Jeremy Hook bringing you this update. Matt, after a long period of time when there was really no big changes to super, it was rather simple, it's gone and got really quite complicated again.
Yeah, absolutely. Look, what happened 29th of November, it received royal assent, the changes to super. We've had 10 years of really simple super. We're going back to more complexities than the old RBL limits. So there's a lot people need to, get their teeth into and make sure they've got it covered.
And the good thing is there are good opportunities for people to take advantage of these rules and save very large amounts of tax potentially. But equally, if you don't do something, you're not only missing opportunities, but it could cost you.
Look, we're looking at 5 or so things that we think really are going to point to what people need to be looking at, particularly, especially coming into 1st of July 2017. So we'll run through those.
Let's get through them. So we're going to give 5 main areas which are factual changes that have to happen. And then we're going to look at some case studies to show you exactly how you can manage those changes.
Yep.
The first real change of significance is this is the last time you can get as much as $540,000 into super.
So you've got up to the 1st of July 2017. This is the last year you're going to be able to use the current caps, which are $180,000 per year, or rolling 3 years into one, being $540,000. So it's a big opportunity to get a reasonable chunk if you've got investments outside of the superannuation. Now, those investments could be an investment property, personal shares in your personal name. You could be coming into an inheritance or something like that. You just need to act now. The opportunity is going to go come 1st of July. They're reducing that significantly.
Okay, so that's something that really is front of mind. You probably need to get onto that one soon rather than just about anything else, because
Absolutely.
Getting some assets into a position you can get them into super may take a little bit of time as well. So Talk to us about that. Secondly, Matt, contributions, concessional contributions, the amount you can put into super will fall on 1 July.
Yeah, so look, most people would be maximising their concessional contributions if they're on a relatively high marginal tax rate. The contribution cap over 49 at the moment is 35,000. That's reducing to 25, and it's going to be a flat rate for everyone at 25. Look, most people are probably doing this, but certainly you need to make sure you're taking advantage of it if it's applicable.
Yep, so get onto that one. Thirdly, the transition to retirement income streams will no longer exist 1 July.
Well, they will exist, but they won't have the tax exemption. So effectively the use of them goes a little bit out the window. It's a little bit more complicated, this one, but if you are between 55 and 65 and you're running a transition to retirement pension, up till now you've been getting the tax-free status of all the earnings within that pension. Come 1st of July, there'll no longer be a tax-free status. So you'll be similar to accumulation phase, and you may as well roll back to accumulation phase if you can't roll into an account-based pension. Now, there's triggers of release that you may meet, and especially if you're over 60, there's various ways you can roll into an account-based pension. It's just really important to make sure you do so if you're able. And also probably to check that your member balance isn't sitting in transition to retirement, unbeknownst to you, because you could be in, could be detrimental.
So A, find out whether you are, and B, speak to us, because each situation is likely to be different. And fourthly, there is a cap on lifetime contributions, $1.6 million. Tell us about that, Matt.
Yep. So that cap is on non-concessional contributions, so the after-tax type of contributions, which is that 540 we were talking about before. So come 1st of July, if you have 1.6 million in super, you're no longer going to be able to put any non-concessional after-tax contributions in there.
Okay, excellent. So that one is one to certainly note. And finally, the pension transfer balance cap, also 1.6 million there.
Yeah, absolutely. So this is where a couple of case studies will explain this a bit better, but if you have more than 1.6, you can only have 1.6 in an actual pension balance. So beyond that, if you had $2 or $3 million in super or $2 million in member balance, you'd have to roll 400,000 back into accumulation phase. Now we touch on this
Or
more,
take it out of super. But
or take it out of super.
it's going to be more favourable to keep it in accumulation.
Generally, well, depending on your marginal tax rate outside of super, but we'll run through that. Yeah.
Yeah, excellent. Okay, well, they're the changes. Now let's have a look at a couple of case studies to work out how it might apply. The first one is the environment where you're bringing forward those contributions to get them done before June 30 and maximise that generous 540,000 limit.
Yep, absolutely. And this is one, we've used an example here. A lot of people might not realise if you're not over that 1.6 or if you're getting close to that 1.6, you can still put 540,000 in. So the example here, Peter's 59, he's already got 1.5 million in his super. He can actually this year put in 540,000. So at 30th of June, as long as he does it before 30th of June comes, he'll have about 2.04 in superannuation. When he commences a pension, he'll actually have to roll back 440,000 of that. What we like about this, though, he's earning 100,000 in income in his own name still. He's going to be paying a much higher marginal tax rate in his personal name. So he's better off having that in the super environment, albeit accumulation.
Okay, yep, excellent. So that'll make a lot of sense to everybody in that environment. Second case study, something quite different, talking about death benefits and the cap of $1.6 million.
Yep. Look, the reason we've included this is because I think this will resonate a little bit more with a lot of clients. A lot of what we've talked about is if a single member balance is 1.6 or a couple combined 3.2, which is quite a big balance. This is one, James and Judy, age 76 and 72, they've got pension accounts, they've had even balances over a period of time, so they've got about 1.3 each. James passes away. Now, we've put a graph on the next page which you can have a look at. So when James passes away, Judy's effectively got 300,000 left of her 1.6 million lifetime cap. Because Judy is set up as a reversionary pensioner for James, she's got 12 months to effectively restructure her affairs before James, his pension becomes her pension. Now, if you add 1.3 to her pension, she'll be well over the lifetime cap. And that excess $1 million will actually have to come completely out of the superannuation environment, which obviously could be a pretty big problem.
Absolutely, much more tax. So you've got 12 months from that date of death to get things organised under the new rules.
That's correct, that's correct. What we've shown is what Judy would do is roll back within that 12-month period $1 million into her accumulation balance. You can see that there, the fourth column there. Then her cap is 1.3 effectively, because she already had 300,000. When James's reversionary pension comes over to her, that can go into her pension balance cap, because she's effectively clawed back $1 million of that.
Yeah, excellent. That's good financial management there. Case study 3 moves on to the example where we've got somebody who is drawing over the pension minimum.
Yep. Look, we've put this in as well. It's something not everyone would know about, but when you're in a pension, you obviously need to take the pension minimum. With the new rules up to this point, because your pension's always entirely tax-free, it hasn't really mattered. You just continue to take any excess as a pension. So we've put this scenario forward where Anita's 62. She's got a pension balance of about 1.4 million at the 1st of July. She's activated her pension cap, so she is drawing a pension. And what this means is she's got 200,000 left between her 1.4 and the 1.6 cap, where it tops out. So she wants to draw, she's going to draw her minimum pension in the 17-18 tax year, which is 4% at her age, $56,000. She also wants to do some renovations. Now, we have a lot of clients who are in this situation, want to draw a little bit more out than their pension minimum in a particular year. Now, if she takes that extra 100,000 as a lump sum, it actually reduces the pension balance that she's used up. So instead of her having 200,000 as a cap space, she's effectively got 300,000 left in her cap. Now, it's a pretty simple thing to do. It just means you're taking a partial commutation rather than treating it as a pension. It's just an accounting function, but it effectively leaves space in the future for an inheritance or if she had an investment property or whatever.
And again, it's a really smart thing that we provide the advice around
Yep.
and link in with the accountant to make sure
Yep.
it happens.
Yep.
And again, preserves the maximum amount in super for all its tax benefits.
Absolutely. Yep.
Okay, now bringing all of this together about what we need to be looking at right now and what we need to be perhaps considering for the future. So, in conclusion, maximising your contributions,
Yep.
both the non-concessional and concessional,
Yep.
before 30 June.
Yeah, absolutely. So 540,000, if it's applicable to you, if you have that sort of money outside of super that needs to go in, you need to get it in before 30 June.
And to be thinking about it as soon as possible.
Absolutely, yeah. Well, as you mentioned, some of these assets could take some time to realise the value of it and then get the money into super. So you need some forward planning on that. We've got about 4 or 5 months to go, so that's okay, but you'd be looking at it now. Maximising your 35k contribution, so everyone probably should be doing that, but just this is your last chance to get that full 35k, so you'd be doing that.
And then on the transition to retirement income stream, making sure you've sorted that one out as well.
Yeah, absolutely. Look, there's a few other things you can do around that transition to retirement, but certainly having a look at your member balance and making sure if you are in transition to retirement, come 30th of June, you're doing something about it. The other thing is with that 540k contribution is evening up your member balances. Particularly the case if in a couple, one member's closer to that 1.6 million, the other one's 800,000 or something like that, and you don't have other assets outside of super to get in, you may use that 540 contribution to reduce one member's pension and bring up the others. So.
And equally, I think too, some will be thinking, I don't have 540, but I've got 2 or 3 or 400,000. That's still very much advantageous to be talking about making those contributions.
Absolutely, yeah. The money in super, and the money can always come out of super, so there's no issues there. You're better off getting it in that concessionally taxed environment.
So they're the things that you need to be looking at, talking about with us soon. There are the other things as mentioned in the case studies 2 and 3, which are very much longer term planning, which will happen in the years ahead. And we, as always, will be here ready to provide that advice. Well, that's all we've got time for now about this. Hope it's been useful, but do by all means get in touch to follow up on the issues we've raised today.